Valens Research, Uniform Financial Analytics.
For those of you who don't know NVIDIA, the largest at this point chip company in the world based on market cap, NVIDIA is a maker of semiconductor chips. In particular, they focus on what are called GPUs, right? Used to be called graphic processing units. Now they're called general processing units. Historically, these have been used from gaming systems for computers, for et cetera. But then what everybody realized over the last 5 years was they're actually phenomenally useful to be able to be used for AI. And also they're really powerful to be used for crypto mining. And so because of that, NVIDIA has seen a phenomenal rise in its stock price, right? Over that time period, its stock price has taken off. And we would assume that they've profited a great deal about it too. Let's see if the uniform accounting and the as reported metrics reflect that. So to get there, what we're going to look at with NVIDIA is the first place we always come in our uniform accounting framework and balance research, which is this tab, the performance and valuation prime tab, or PVP. We call it that again because we're very literal people here at Balance. We're looking at the performance of a company in terms of its return on assets and its asset growth, how profitable it is and how much it can reinvest, and its valuations in terms of its valuations relative to assets and its valuations relative to earnings. Right, this is, if you look, right, our return on assets here, asset growth, valuation relative to asset, which is very similar to a price to book, and valuation relative to earnings, which is a PE, our uniform accounting adjusted version. What you'll see here is for each of these charts, there's an orange bar and a blue bar. This orange bar is the orange distorted as reported return on assets for this company, right? This is anybody who's looking at the financials as they're presented, what you understand the real profitability of NVIDIA to be, and how you might think about their competitive moats and everything else. This blue bar is when we clean up the accounting and remove the noise, when we can really see the profitability of this business to be, and what it tells us in terms of, does this company have competitive moats? Does it have high returns, et cetera? And what we can see with NVIDIA, which is so powerful, is the as reported metrics massively understate how profitability NVIDIA is. On an as reported basis, NVIDIA has a 13% return, which is barely higher than NVIDIA's. It's actually below what its return was in 2018, and really not that much higher than what it had been for prior years. Well, in reality, when we look on a uniform accounting basis, we can see how AI and crypto have massively lifted the company's returns. The company's returns have more than doubled over that time period. They haven't only slightly improved, and they're significantly higher than they were historically, right? NVIDIA actually has seen a real lift in profitability because of AI. And not only has it seen a real significant lift because of AI, it actually has a higher return and a more sustainable return than it has before. We can see this if we look at the the uniform accounting EPS too, where even each year, as reported to uniform accounting EPS, uniform accounting shows this company is actually more profitable than the as reported metrics reflect. Now let's think about the other parts of the equation here when we look at NVIDIA. What we can also see with NVIDIA is whether or not it's reinvesting in the business. And what's interesting here is, right here, there are several points where it actually looks like NVIDIA is investing when in reality, they weren't investing as much as reported metrics reflect, which is important. It says NVIDIA has actually been more focused on profitability than it's been focused on growth, even though this growth is still very healthy for the business. But this is a question that you're not understanding if you're looking at as reported metrics. The other things that we're looking at are, right, price relative to its asset base, relative to a price to book, and its price relative to its earnings. What we can see here is on this basis, the market actually correctly as reported metrics correctly reflect how the company's valuations are and how high they've got. But what's really telling is this chart right here, which I haven't talked about yet. This chart is TSR-R. What does that mean? TSR means total shareholder return. That is the total return you as an investor would have gotten if you'd owned the stock based on both the capital appreciation, the stock going higher, and also any dividends that NVIDIA has paid. And then that second R, that little r, that's relative. Relative to what? Relative to its index. For NVIDIA, because it's a US listed name, it's relative to the S&P 500. When this line is flat, that shows us that the company performed in line with the market. When it's down, that showed us the company underperformed the market's performance in terms of total stock gains. And when it's up, like it is these years, well, that shows us the company is outperforming the market. And what's really interesting is, more often than not, what we can see is this trend in return on assets and asset growth really directly explains what we're seeing here in terms of TSR-R in a way that oftentimes the as-reported metrics don't. Right here, what we can see is ROA started to rise, TSR started to rise. Then ROAs have stayed well above where they are historically, even though they came down slightly, while the company was massively investing and the market rewarded that too. But that alone doesn't tell us whether or not this company is a buy or not. And that's where these last 5 bars in both the ROA and asset growth perspective help us understand what's going on for the company. What these 2 light blue bars are what Wall Street sell-side analysts are forecasting the company's profitability and growth to be. We take the as-reported forecast they estimate, and then we push them through the uniform accounting framework. Right? What Wall Street is expecting is that return on assets for NVIDIA is going to spike higher this year from last year and return to the levels that were its peak from 2018. These 3 white bars and these 4 white bars here are what the market is pricing NVIDIA to do at a $500 billion market cap or a $200 stock price. The market right now is pricing NVIDIA not like it is a 42% return on assets business and it's going to grow at 20% a year, but that it's going to get to a 91% ROA business. This is the second question when we think about valuations. NVIDIA is a great business, which we can understand far better using uniform accounting metrics than we can on as-reported metrics. But also, it is a business that's priced to double its profitability historically. Mind you, something that if we look at basically any metric on what semiconductor firms historically earn in terms of return on assets, we would see is very improbable. Even if I would say, which I can do using this embedded expectation analysis tool to do scenario analysis here, if I were to say, you know what, I think that the company's growth is going to be higher and the market's pricing that in, say the market thinks the company is really going to grow at 15% a year, still at a $200 stock price, to be worth what the market is pricing it to be, ROA would have to rise from 42% next year to 70%. Right? That is insanely high. And this is the other part of the equation that we can understand so quickly using uniform accounting that would take you, right, hours, if not days, to build a model using as-reported metrics and using Excel to build. We can understand not just whether or not it's a good or a bad company, which, by the way, we couldn't know using as-reported metrics. Literally, it doesn't represent the company's real profitability using as-reported metrics, but we can also literally in 5 seconds, call it 3 minutes that we just did the scenario right here, we can also understand what a company's real valuation is, what the market's really pricing the company to do. And we can say, well, you know what, if the market is pricing the company to keep on growing at the rate it has been, and for ROA to basically go up by a half going forward, when the company already has the peak ROAs of any semiconductor firm, which we could see looking at it versus peers, that's a lofty goal to look at. So whether, even though it's a great business, we can also understand very quickly, do we think there's a scenario where this could happen? We'd probably say no, but we couldn't even have that conversation if we were talking about as-reported metrics, because on an as-reported metrics basis, we might think it's a lower return business than some of its peers, and it could still see a lift in returns, not realizing it already is at peak returns. It's going to be really hard for it to push higher.
Valens Research, the world's leading source for uniform financial analytics.